Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here with Sam Shuttleworth, a partner at PricewaterhouseCoopers, and we're going to be discussing PricewaterhouseCoopers' twice-yearly Banking Perspectives report, which is a pretty comprehensive wrap-up of the sector, especially the country's big banks. Sam, this is your second look at it, obviously, this year. What have you found this time?
Look, it's quite interesting for this current 6 months. So this is focusing on their first half of their financial years. It's been a really resilient result. You know, when you look at what's happened within the country, we're talking about the Christchurch earthquake here. We're looking at, I guess, the lack of economic growth. The results compared to, the second half of last year, it's pretty flat. It's pretty stable. And after seeing all the change that we've experienced in the last 2 years, I'm pretty happy for once to sit here and to stand here and talk about, a resilient result with not much volatility going on.
So how are the banks doing that?
Look, I think when you look at the numbers, they should be very comfortable with this result. There has been lack of growth in the balance sheet, but to come out with statutory profits there or thereabouts same with last year, when you incorporate there has been a one-off event with the Christchurch earthquake which has resulted in increased provisioning for, I guess, the credit impact of that, they'll be sitting back and thinking, well, this is a nice stable platform, we just need some confidence, we need some growth, and this will kick on reasonably well.
Now, obviously, we've seen a big switch from fixed to floating mortgages in the last couple of years. I think at last count about 56% of home loans were floating now. Obviously, we're in an environment where interest rates are predicted to go up. The banks do better off the floating rates. What's your outlook for that particular market, and what might that mean for the banks?
Yeah, look, personally, I've been debating that myself, whether I fix or float. The banks have profited from the weight of residential borrowers on floating. That said, the residential borrowers, they've also profited because the floating rates have been lower than the fixed rates. So it's been a win-win situation. The interesting thing will happen is we know there's some increases coming. What will the public do? This could fuel competitive pressures again for fixed rate. And also bearing in mind, the banks do like a wee bit of fixed rate lending because it gives them a bit more security. If everyone's floating, there's a greater ability to switch banks, right? If they're fixed on the fixed mortgages, therefore they're more, I guess, secure customer base. So I suspect we'll probably see over the coming months, my personal expectation is we'll see, I guess, a movement away from floating to fixed. How much, I don't know. But also if you look forward, in a year's time, if nothing else changes, 80% of the market will be floating. So to me that does indicate there will be fixed changes coming.
Now you've talked in your report too about a lack of balance sheet growth going on, and how the return on equity for the Kiwi subsidiaries of the big Aussie banks lags behind their parents, and that there might be some pressure come on from the shareholders over in Sydney and Melbourne for the branches over here to boost that. Where do you think they can get some balance sheet growth from, and indeed could this perhaps lead to this potential price war in the fixed mortgage market that you're referring to? Yeah,
to bolster the return, I guess one is to grow the book, right? And a lot of that is driven by macroeconomic forces. So that's what it is. How would a bank do it? Well, it's all about bringing innovative customer experiences. Making sure their consumers or their bank, their customers want to be associated with the bank. So that's a big push, and you can start to see the banks differentiate themselves, coming up with plans to do that. Right. The other aspect, I guess, where they can focus in on is looking at those costs. Interestingly, in the last 6 months, their operating expenses have increased by circa 80 to 90 million. That's been driven by, I guess, three things. One is, increased personnel costs. They've increased. There is also increased spend in the IT environment to kind of support, that strategy to increase the customer experience, but also to replace ageing systems. And the third thing, of course, is not to be forgotten, is that 1 October, GST went up, and that is a big cost to the banks. They cannot fully recover the GST that they pay out on their expenses, and so that's actually impacted their bottom line.
And look, deleveraging's been the big story for a couple of years now. Are we seeing any significant turnaround in that yet? And can we separate the residential side and the business side of that equation?
Yeah, so what we've seen in the last 6 months is that actual residential lending is still increasing. Yeah, it's not huge by any stretch, but there is growth. Whereas flip side on the corporate, again, we're seeing that trend continue. There is deleveraging occurring, and that is falling off. Looking forward, with the forecast increase in GDP growth for next year, look, that will be good for the corporate appetite to fuel investment and to, I guess, to gear their business up for this growth. The interesting thing will be, though, of course, is how much of, I guess, the corporate's investment will be bank funded, and how much will continue to be, I guess, funded by the retail market by doing these kind of retail bonds.
And look, just in terms of that balance sheet growth, I mean, any other particular areas where you think that could come from?
I guess in today's environment, diversification of income streams is very important. If you look across the Tasman there in Australia, they have greater product ranges, greater product channels, high focus on wealth as an example, where all the banks are major players. So I guess how you can supplement the core earnings by other income sources will be an opportunity for the banks there to investigate. So
I mean, is that wealth area, is that an area where you expect to see some activity, and could we see some acquisitions of fund managers or wealth managers by the big banks here?
Yeah, I guess it's something you can never rule out, and also I guess with the focus on saving, if anything that's going to increase then decrease. So you've got to explore all opportunities to see how you can bring further, I guess, revenue or business into the banks. And of course, once you're there, then it's a great opportunity to cross-sell.
And obviously another key area for the banks is the funding side. Now, yes, the big banks are all pretty well funded because lending growth has been weak.
Yep.
But looking ahead to next year, if we do get the economic growth of 4.5% that some economists are predicting, funding may become more of an issue. And obviously you've made the point that the big banks have high penetration in the domestic market,
yep,
get about 36% of their funding overseas. Overseas picture is very unsettled, obviously,
mm-hmm,
the US and Europe. Do you see any major concerns for the banks' funding looking ahead the next 12 to 18 months?
Yeah, one of the greatest lessons from the GFC that the local banks have learned is looking at liquidity and looking at liquidity risk, right? So they'll be focused on this. They're well attuned to what's happening globally, and so they'll be positioning the balance sheet to ensure that they can fund the business and they can fund the growth. So yeah, they're aware of the risks. However, they've put appropriate checks, balances, controls, and diversification of funding. For example, the covered bond program. That they are well positioned to fund their book when this growth comes on. But I take your point about the Northern Hemisphere. It used to be changing weekly. It's now changing daily. Next week will be different to this week, but it is a focus and a hot point that the banks are all monitoring.
Well, thanks a lot for that, Sam. That's Sam Shuttleworth, a partner at PricewaterhouseCoopers, talking about his firm's latest twice-yearly Banking Perspectives report. And I'm Gareth Vaughan from interest.co.nz.